Chapter 3, Life and Health Insurance. Chapter Objectives. Dear learners, after completing this chapter, you are expected to describe life insurance, understand how to underwriting life insurance, identify the types of life insurance policies, demonstrate how to determine premium for life insurances, explain life insurance, identify the types of life insurances. 3.1 Introduction. Human values, aside from being more important to us from a personal standpoint, are far greater and more significant than all the different property values combined. The true wealth of a nation lies not in its natural resources or its accumulated property, but in the inherent capabilities of its population and the way in which this population is employed. A careful study of the specific types of economic loss caused by the destruction of life or health is vital to an understanding of the insurance methods available to offset these losses. Life values. A human life has value for many reasons. Many of these reasons are philosophical in nature, and would lead us into the realm of religion, aesthetics, sociology, psychology, and other behavioral sciences. Of greatest interest here are economic values, although it is very difficult to separate the discussion in such a way that an economic analysis would have no implications or overtones for other viewpoints. A human life has economic value to all who depend on the earning capacity of that life, particularly to two central economic groups, the family and the employer. To the family, the economic value of a human life is probably most easily measured by the value of the earning capacity of each of its members. To the employer, the economic value of human life is measured by the contributions of an employee to the success of the business firm. If one argues that in a free competitive society, a worker is paid according to worth and is not exploited, the worker's contribution again is best measured by earning capacity. It develops that earning capacity is probably the only feasible method of giving measurable economic value to human life. There are four main perils that can destroy, wholly or partially, the economic value of a human life. These include premature death, loss of health, old age, and unemployment. 3.2 Life insurance. Life insurance is a contract between the policy owner and the insurer, where the insurer agrees to pay a designated beneficiary a sum of money upon the occurrence of the insured individual's death or other event. Life insurance is an insurance coverage that provides a monetary benefit to a decedent's family or other designated beneficiary, and may specifically provide for income to an insured person's family. Life insurance policies often allow the option of having the proceeds paid to the beneficiary, either in a lump sum cash payment or in an annuity. The primary purpose of life insurance is to protect financially the insured's family in the event of the insured's premature death. Premature death is the death of a family head with outstanding unfulfilled financial obligations, such as dependents to support, children to educate, and other debt. Premature death can cause serious financial problems to the surviving family members, unless they have other source of fund, since their share of the deceased breadwinner's earning is lost forever. 3.2.1 UNDERWRITING Life insurance. Underwriting is the process through which an insurance company evaluates the risk of a potential client, and this process allows the company to set premiums and coverage specific to the individual. Life insurance underwriting consists of both medical underwriting as well as non-medical underwriting. Medical underwriting is an insurance term referring to the use of medical or health status information in the evaluation of an applicant for coverage, typically for life or health insurance. As part of the underwriting process, health information may be used in making two related decisions. A. Whether to offer or deny coverage. B. What premium rate to set for the policy. The use of medical underwriting may be restricted by law in certain insurance markets. Where allowed, the criteria used should be objective, clearly related to the likely cost of providing coverage, practical to administer, consistent with applicable law, and designed to protect the long-term viability of the insurance system. To conduct medical underwriting, an insurer asks people who apply for coverage, typically people applying for individual or family coverage, about pre-existing medical conditions. Life insurance. Companies each have their own extensive policy and procedure manuals they are supposed to follow in determining whether or not to issue an individual life insurance policy, and in pricing that policy. The insurer's underwriters typically use a combination of factors that experience shows equates with the risk of death and premature death. They include the applicant's answers to a series of questions such as A. Age, B. Sex, C. Height and weight, D. Health history and often family health history, parents and siblings, E. Marital status and number of children, F. Occupation, some are hazardous, and increase the risk of death, G. Smoking or tobacco use, this is an important factor, as smokers have shorter lives, H. Alcohol, excessive drinking seriously hurts life expectancy, I. Drug use, J. Certain hobbies such as race car driving, hang gliding, piloting non-commercial aircraft, and K. Foreign travel, certain foreign travel is risky. Why is underwriting important? The main purposes of life insurance underwriting are A. To prevent individuals who have a higher than average probability of loss from obtaining insurance at average rates, B. To decide whether to offer or deny the coverage, and C. To set the premium rate for the policy. Diseases that can make an individual uninsurable include serious conditions such as A. Cancer, B. Heart disease, C. Overweight and underweight, D. Diabetes, E. Blood pressure, etc. Check your progress. 3.1. 1. What are the basic decisions in medical underwriting? 2. List diseases that can hinder individuals from life insurance. 3.2.2. Unique characteristics of life insurance. Life insurance is a risk-pooling plan economic device through which the risk of premature death or superannuation is transferred from the individual to the group. However, the contingency insured against has certain characteristics that make it peculiar. As a result, the contract insuring against the contingency is different in many respects from other types of insurance. First, the event insured against is an eventual certainty. No one lives forever or maintains his economic value, yet we do not violate the requirements of an insurable risk in the case of life insurance, for it is not the possibility of death itself that we insure against, but rather untimely death. The uncertainty surrounding the risk in life insurance is not whether the individual is going to die, but when. Second, life insurance is not a contract of indemnity. The principle of indemnity applies on a modified form in the case of life insurance. In most lines of insurance, an attempt is made to put the individual back in exactly the same financial position after a loss as before the loss. For obvious reasons, this is not possible in life insurance. The simple fact of the matter is that we cannot place a value on a human life. Third, as a legal principle, every contract of insurance must be supported by an insurable interest. But in life insurance, the requirement of insurable interest is applied somewhat differently than in property and liability insurance. When the individual taking out the policy is also the insured, there is no legal problem concerning insurable interest. The important question of insurable interest arises when the person taking out the insurance is someone other than the person whose life is concerned. In such cases, the law requires that an insurable interest exists at the time the contract is taken out. There are many relationships, as stated earlier, that provide the basis for an insurable interest. Fourth, life insurance contracts are long-term contracts. Nearly all life policies are intended to continue until the insured's death or at least for several years. Other forms of insurance policies may be renewed many times, but are usually 12-month contracts, which may be terminated by either party. Finally, the question of overinsurance is immaterial in life insurance contracts. Check your progress. 3.2. Explain how the insurance contract for life insurance differs from other insurance contracts. 3.2.3. Basic types of life insurance contracts. Not all people need exactly the same kind of protection from life insurance. Their ages differ, their incomes and financial obligations differ, and the number of their dependents differs. To provide all the different types of protection that are needed, insurance companies offer a variety of policies. The basic types of contracts are 1. Term insurance, 2. Whole life insurance, 3. Endowment insurance, and 4. Annuities. Term insurance. Term insurance provides protection only for a definite term of time. A term insurance policy is a contract between the insured and the insurer whereby the insurer promises to pay face amount of the policy to a third party, the beneficiary, should the insured die within a given period of time. If the insured does not die during the period for which the policy was taken, the insurance company is not required to pay anything. Protection ends when the term of years expires. In other words, term life insurance resembles automobile insurance, fire insurance, and the like, which are always term insurance. Term insurance is sometimes called temporary insurance. Common types of term life insurance are 1-year term, 5 years term, 10 years term, 20 years term, and term to age 60 or 65. There are different forms of term insurance available to the potential purchaser, viz. straight term insurance, renewable term insurance, and convertible term insurance. Straight term insurance is written for a year or for a specified number of years and terminates automatically at the end of the designated period. Renewable term insurance is a type of contract under which the insured may renew his policy before its expiration date without making another medical examination or otherwise proving that he still is insurable. If the policy is renewable, the insurer will renew the policy, regardless of the insurability of the insured, for the number of times specified in the contract, commonly to age 60 or 65. Convertible term insurance is available from most life insurance companies. This insurance may be converted at any time during a specified period into a permanent form of insurance without taking a physical examination. Some insurance companies write a convertible term policy which provides that at the expiration of certain period of time the term insurance policy automatically will be converted into a permanent form of insurance. This is called automatic convertible term insurance. In most cases, these policies provide that term insurance will be converted to a continuous premium whole life policy. Term insurance is suitable for ensuring any need for protection, which is not lifelong duration. Non-continuing needs for insurance. For example, a man with a mortgage that will take 10 years to amortize can use term insurance to provide insurance protection during the mortgage period. Mortgage insurance protects homeowners from losing their homes in case the insured person dies before the mortgage is paid off. Whole life insurance. As the name suggests, it is a permanent insurance that extends over the lifetime of the insured. The sum insured is payable on the death of the life insured. In other words, whole life insurance protects the beneficiary when the insured dies, since the contract can be continued in force as long as the insured lives. Whole life insurance contracts may be placed in 2 categories, depending upon the premium payment period. 1. Straight life insurance, and 2. Limited payment life insurance. Under straight life insurance, the premiums are payable for the remainder of the insured's lifetime. Under limited payment life insurance, the premiums are payable for the remainder of the insured's lifetime or until the expiration of a specified period, if earlier. A limited payment life policy is one arranged so that the insured pays a higher premium than would be required on the straight life contract. Thus, a definite termination date can be established beyond which no further payments are due. Limited installment plans could be 20 payment life, 30 payment life, and life paid up at age 65. There are many different ways of arranging premium payments for whole life insurance, ranging from continuous installments over a person's entire life to a single installment, single premium whole life. In other words, an insured, at age 35, may pay a single sum, say 5,000 birr for a 10,000 birr policy, and never pay another premium. At the time of death, the insurer pays the insured's beneficiary 10,000 birr. If the insured does not have 5,000 birr with which to pay the single premium, and few do, it may be paid by installments over whatever length of time is desired. Whole life insurance is the ideal form of insurance for a person with dependent relatives, as substantial life cover is obtainable for the amount of premium payable. Endowment insurance. Endowment insurance promises to pay a stated amount of money to the beneficiary at once if the insured dies during the life of the policy, called the endowment period, or to the insured himself if he survives to the end of the endowment period. This is You win if you live and you win if you die. Contract. The endowment policy is, in a sense, a savings plan, which also gives insurance protection. Under this type of contract, the sum insured becomes payable at a maturity date on the expiry of a fixed term, say 10 or 20 years, or at death before that date. Endowment insurance may be a useful way for some persons to accumulate a specified sum over a stated period of time, whether they live or die. The objective may be funds to finance a child's college education, to pay living expenses during retirement, or to retire a debt. Annuity contracts. An annuity may be defined as a periodic payment to commence at a stated date and to continue for a fixed period or for the duration of a life. The person whose life governs the duration of the payments is called the annuitant. Annuity is insurance against living too long, against outliving one's ability to provide an income for oneself. Annuities can be classified according to several characteristics. First, annuities can be classified as immediate or deferred, depending upon whether the benefits are payable immediately after the purchase of the contract. The rent of an annuity can begin as soon as the annuity is purchased, in which case the transaction is called an immediate annuity. Alternatively, the rent can begin at some future time, in which case the annuity is called a deferred annuity. Often the rent begins at retirement. Second, annuities may be paid for by a single premium or by annual premiums. An annuity can be wholly paid up in a lump sum payment, or it can be purchased in installments over a period of years. If the annuity is paid up at once, it is called a single premium annuity. If it is paid for in installments, it is known as an annual premium annuity. Third, annuities may cover one life or joint lives. If two or more lives are covered, the payments may stop at the death of the first annuitant or at the death of the last annuitant. An annuity may be issued on more than one life. For example, the agreement might be to pay a given rent during the lifetime of two individuals, as long as either shall live. This, a very common arrangement, is known as a joint and last survivorship annuity, because the rent is payable until the last survivor dies. The rent may be constant during the entire period, or may be arranged to be reduced by, say, 1/3 upon the death of the first annuitant. Thus, a husband and wife both age 65 may elect to receive the proceeds of a pension plan on a joint and last survivorship basis, with an income guaranteed as long as either shall live. Check your progress. 3.3. 1. Differentiate straight term insurance and renewable term insurance. 2. Distinct between straight life insurance and limited payment life insurance. 3.3. Premium determination for life insurance. Rate making refers to the pricing of insurance. An insurance rate is the price per unit of insurance. The process of predicting future losses and future expenses and allocating these to costs among the various classes of insured is called rate making. Life insurance rates are influenced by three major determinants. A. Expected mortality rates in the insured population. B. Investment income earned by insurer on invested premium income, and C. Expenses incurred in operating an insurance enterprise and in providing insurance-related services. Mortality table. Mortality table is a table that shows the number of deaths per thousand and expectation of life at various ages. This table, which is revised periodically, states the probability of death both in terms of deaths per 1,000 and in terms of expectation of life. Example: Commissioner's Standard, Ordinary, CSO. Mortality Table 1980 reveals that male age 20 has an expectation of living 52.37 years. At age 20, 1.90 men in every 1,000 are expected to die before they become 21. The probability of death at age 20 is thus 0.0019. The probability of death expressed in a mortality table is based on insured lives and not the whole population. 3.4. Health insurance. Health insurance may be defined broadly as the type of insurance that provides indemnification for expenditures and loss of income resulting from loss of health. Health insurance is insurance against loss by sickness or bodily injury. The loss may be the loss of wages caused by sickness or accident, or it may be expenses for doctor bills, hospital bills, medicine, etc. 3.4.1. Types of health insurance. There are two types of insurance in the generic term health insurance. 1. Disability income insurance, and 2. Medical expense insurance. Disability income insurance. Disability income insurance is a form of health insurance that provides periodic payments when the insured is unable to work as a result of illness or injury. It may pay benefits only in the event of sickness or only in the event of accidental bodily injury, or it may cover both contingencies in one contract. Benefit eligibility presumes a loss of income, but in practice this is usually defined as the inability to pursue an occupation. The fact that the insured's employer may continue his or her wages does not reduce the insurance benefit. The disability must be one that prevents the insured from carrying on the usual occupation. Most policies continue payment of the benefits for only a specified maximum number of years, but lifetime benefits are available on some contracts. However, under all loss of income policies, the benefits are terminated as soon as the disability ends. Certain types of accidents are excluded, for example, losses caused by war, suicide and intentionally inflicted injuries, and injuries while in military service during wartime. Medical expense insurance. Medical expense insurance provides for the payment of the cost of medical care that result from sickness and injury. Its benefits help meet the expenses of physicians, hospital, nursing and related services, as well as medications and supplies. Benefits may be in the form of reimbursement of actual expenses, up to a limit, cash payments or the direct provision of services. The medical expenses may be paid directly to the provider of the services or the insured. Medical expense insurance is divided into four major classes. 1. Hospitalization expense contract. 2. Surgical expense contract. 3. Regular medical expense contract. 4. Major medical expense contract. Hospitalization contract. The hospitalization contract is intended to indemnify the insured for necessary hospitalization expenses, including room and board in the hospital, laboratory fees, nursing care, use of operating room, and certain medicines and supplies. Hospitalization expense is usually written for a flat daily amount for a specified number of days, such as 30,120 or 365. The contract provides that costs up to the maximum benefit per day, say 40 birr, 50 birr, 70 birr etc., will be paid for the number of days specified, while the insured or an eligible dependent is in the hospital. The agreement may set birr allowance for the different items or may be on a service basis. Typical contracts offered by insurance companies, for example, may state that the insured will be indemnified up to X birr per day for necessary hospitalization. Exclusions under hospitalization contracts. Like all insurance policies, hospitalization contracts offered by insurers are subject to exclusions. The following exclusions are typical of hospitalization contracts. 1. Expenses resulting from war or any act of war. 2. Expenses resulting from self-inflicted injuries. 3. Expenses payable under workers' compensation or any occupational disease law. 4. Expenses incurred while on active duty with the armed forces. 5. Expenses incurred for purely cosmetic purposes. 6. Expenses incurred by individuals on an outpatient basis. 7. Services received in any government hospital not making a charge for such services. Surgical contract. The surgical contract provides set allowances for different surgical procedures performed by duly licensed physicians. In general, a schedule of operations is set forth, together with the maximum allowance for each operation. It reimburses the policyholder according to a schedule that lists the amounts the policy will pay for a variety of operations. Regular medical contract. The regular medical expense insurance pays part or all of a physician's ordinary bills, such as his calls at the patient's home or at a hospital or a patient's visit to his office. It is a contract of health insurance that covers physicians' services other than surgical procedures. Normally, regular medical insurance is written in conjunction with other types of health insurance and is not written as a separate contract. Major medical contract. The major medical expense insurance provides protection against the very large cost of a serious or long illness or injury. The major medical policy is most appropriate for the large medical expenses that would be financially unaffordable for the individual. The contract is issued subject to substantial deductibles of different sorts and with a high maximum limit. Since this kind of policy is designed to cover only serious illness or accidents, a deductible is used to eliminate small claims. A major medical policy might have a 5,000 BR maximum limit for any one accident or illness, have a 200 BR deductible for any one illness, and contain an agreement to indemnify the insured for a specified percentage of the bills, such as 80% over and above the amount of the BR deductible. This means the insurance company pays 80% of the loss in excess of the deductible, and the insured pays the 20%. In the absence of the co-insurance clause, there would be no incentive for the insured or the doctor to keep expenses within reasonable limits. 3.5. Workers' compensation, employer's liability insurance. Workers' compensation insurance covers loss of income, medical, and rehabilitation expenses that result from work-related accidents and occupational disease. Insured workmen always retain the right to claim damages. Employers' liability claims become much more common, aided by trade unions. If an employee is killed or injured at work as a result of an accident arising from defective premises or equipment, then a court may award damages against the employer. Any employer is liable for an employee who suffers accidental bodily injury or disease while working for him. The employee is thus entitled to compensation for injuries that may be temporary or permanent. This compensation being unforeseen expenditure, the employer finds it difficult to compensation such losses, especially when it involves a huge amount. An employer may therefore take out an insurance policy insuring himself against such claims by his employees. The insurance which provided protection for injuries to employees while at work, and as a result make the employer liable for the loss, is called workers' compensation insurance. In addition to buying insurance, the insured employer can lower the loss claims by a. Providing a safe place of work to his employees, b. Proper plant tools, machinery and working implements, and c. Hiring competent and sober fellow employees. Check your progress. 3.4. Differentiate between disability income insurance and medical expense insurance. Chapter summary. There are four main perils that can destroy, wholly or partially, the economic value of a human life. These include premature death, loss of health, old age, and unemployment. Life insurance is a contract between the policy owner and the insurer, where the insurer agrees to pay a designated beneficiary a sum of money upon the occurrence of the insured individual's death or other event. The primary purpose of life insurance is to protect financially the insured's family in the event of the insured's premature death. Premature death is the death of a family head with outstanding, unfulfilled financial obligations, such as dependents to support, children to educate, and other debt. Premature death can cause serious financial problems to the surviving family members unless they have other source of fund, since their share of the deceased breadwinner's earning is lost forever. Underwriting is the process through which an insurance company evaluates the risk of a potential client. Medical underwriting is an insurance term referring to the use of medical or health status information in the evaluation of an applicant for coverage, typically for life or health insurance. Life insurance is a risk pooling plan economic device through which the risk of premature death or superannuation is transferred from the individual to the group. The contract insuring against the contingency is different in many respects from other types of insurance. First, the event insured against is an eventual certainty. No one lives forever or maintains his economic value. Second, life insurance is not a contract of indemnity. The principle of indemnity applies on a modified form in the case of life insurance. Third, as a legal principle, every contract of insurance must be supported by an insurable interest, but in life insurance the requirement of insurable interest is applied somewhat differently than in property and liability insurance. Fourth, life insurance contracts are long-term contracts. Nearly all life policies are intended to continue until the insured's death or at least for several years. Finally, the question of overinsurance is immaterial in life insurance contracts. The basic types of contracts are 1. Term insurance, 2. Whole life insurance, 3. Endowment insurance, and 4. Annuities. Term insurance provides protection only for a definite term of time. A term insurance policy is a contract between the insured and the insurer whereby the insurer promises to pay face amount of the policy to a third party, the beneficiary, should the insured die within a given period of time. Whole life insurance is a permanent insurance that extends over the lifetime of the insured. The summa NSU read as payable on the death of the life insured. Endowment insurance promises to pay a stated amount of money to the beneficiary at once if the insured dies during the life of the policy called the endowment period, or to the insured himself if he survives to the end of the endowment period. An annuity may be defined as a periodic payment to commence at a stated date and to continue for a fixed period or for the duration of a life. The person whose life governs the duration of the payments is called the annuitant. Rate making refers to the pricing of insurance. An insurance rate is the price per unit of insurance. The process of predicting future losses and future expenses and allocating these to costs among the various classes of insured is called rate making. Health insurance may be defined broadly as the type of insurance that provides indemnification for expenditures and loss of income resulting from loss of health. There are two types of insurance in the generic term health insurance: 1. Disability income insurance, and 2. Medical expense insurance. Disability income insurance is a form of health insurance that provides periodic payments when the insured is unable to work as a result of illness or injury. Medical expense insurance provides for the payment of the cost of medical care that result from sickness and injury. Medical expense insurance further divided into four major classes, as A. Hospitalization expense contract, B. Surgical expense contract, C. Regular medical expense contract, and D. Major medical expense contract.